Hi, my name is Roy Rumbo. I'm an accounting professor at the University of North Texas. And today I'm going to be providing a lecture or working problems on earnings per share and calculation of earnings per share. I do use the McGraw-Hill textbook, Intermediate Accounting, Spicer Nelson Thomas textbook. It's a great book. And again, we'll be working problems today, primarily for my Intermediate 2 class at the University of North Texas, but certainly available via YouTube to others. So with that, hey, it's time to go to work here. And let's see if I have, oh, good, I have this. Otherwise, I have to stop that video and start over again. So let me share my screen here. Again, as you've seen in previous Intermediate 2 lectures, at least, I didn't do this for Intermediate 1, I have a summary sheet for these classes that helps my students, and it's available to them on Canvas. But just gets into how these things are calculated. So basic earnings per share, we're going to take net income. We're going to subtract the preferred dividends because they're not available to the common shareholders, and we're going to divide that by the weighted average of common shares outstanding, not preferred shares. And what's the weighted average share count? Outstanding share at the beginning of the period plus new shares times the months outstanding. Now, note, stock dividends or stock splits have a multiplier effect in the formula. And so we do that from the beginning of the year, from the very first years. If we had 100,000 shares outstanding at the beginning of the year, 10% stock dividend, we're going to multiply that beginning of the year calculation by 1.1 and reflect that from the beginning of the year. A diluted earnings per share, note, hypothetical calculation. Here is what has really happened, actually happened. Here is all hypothetical. Why would we ever use hypothetical in accounting? Because there are a lot of shares out there in the shadows that could become real shares, and that could surprise people who are relying on the basic earnings per share. So we hypothetically go take everything that could be converted into common shares and we convert it. And that has some impact. So, we may, for example, have to adjust the net income in the numerator because of convertible bonds. If the bonds got converted into shares, we'll go add those shares in the denominator. But guess what's not in the numerator anymore? The interest. We had interest expense reducing that income. So we're going to add it back. But we don't add all of it back because there was a tax deduction because interest expense is tax deductible. So we'll reduce that. So again, it's a hypothetical deal here. And then for preferred stock, we are going to add the shares in if the preferred stock got converted into common stock. However, remember in basic, we subtract the preferred dividends. Well, if they got converted January 1, they don't exist anymore. So there we don't subtract the preferred dividends. And then let's see if there's anything else here. Anti-dilutive, if in these calculations, we would actually increase earnings per share. Maybe we added so much interest back that the addition of shares wasn't enough. And so the calculation dilutive was greater than the basic. We ignore that because we're only looking for things that are going to be dilutive, reduce the earnings per share. So that's what we're going to care about. And share-based compensation is also adjusted for our shares related to share-based compensation, especially stock options. We got cash. We'll go and add back the shares we could have repurchased from the cash we received. And I would just note that I don't normally test my students on the EPS, diluted EPS effect for stock options because there are a lot of complex nuances there. And it is available in the McGraw-Hill textbook. So it's good reference materials if we get into a business where you have to do that. But I keep it a little bit easier for my students. It'll be more like what we're working today. So, and if you say, man, I really wish I had a professor, hey, go to UNT. I don't know if you can get me or not because I'm an adjunct now. I don't teach as much as I used to. So, all right, I don't want to do exercise 2. Let's go in the order here. Let's do exercise 1 first. All right. So there's 1 million shares outstanding. 400,000 shares were issued July 1, so we're outstanding for half the year. We had 100,000 shares of preferred stock, $10 par, 10% preferred stock, $10 par. So we know that's going to be a $1 dividend, 10% of 10. If preferred shares convertible, so that's going to come into play on preferred stock, on diluted earnings per share. And there's 1,000 5% convertible bonds. Each bond had a face value of 1,000. So that's going to be 1,000 times 1,000. That's going to be $1 million of convertible bonds at a 5% interest rate. So we'll have to add that back into diluted and add the shares because each bond is convertible to 100 shares. $1 million net income with a 40% tax rate. And that's already included because net income is after tax. So don't have to add that back. Common shareholders receive $2 per share dividends after the preferred shareholders were paid. By the way, that doesn't even come into play in the calculations. So that's, again, where accounting questions and multiple choice could be kind of evil there. So let's do basic EPS first. And we're going to start with the net income in the numerator, 1 million. And we subtract preferred dividends, and that's going to be $10 par times 10% times how many shares? 100,000 shares. I don't know if I want to do it that way or not. Well, let's do it. Well, I'll do it that way. 0.1 million, right? And so that is going to be equal to 1 million. This is 10% of 10 equals 1 times 0.1, 0.1. So 1 million minus 0.1 equals 0.9. I think what I'm going to do, just so I don't confuse people with all my things, it's going to be $900,000. Again, what we've done, net income minus the preferred dividends. That's the numerator. What's the denominator? We had 1 million shares outstanding, 1 million shares of common stock, and we're going to then add in, because we had here, let's look at what it says. I'm looking at the wrong sheet here. We sold 400,000 plus 0.4 million common stock, and that was on July 1. So times 6 divided by 12, right? You know, so it was outstanding July, August, September, October, November, December, 6 months. And so we use a weighted average here. And so now we've got 1 million plus half of that 0.2, 1.2 million, 200,000. Basic EPS equals 75 cents per share. That's pretty easy. That's basic EPS. Diluted EPS. Now we're going to do all of our hypothetical fun stuff. We are going to start with the same 1 million. You know, and do we subtract? I'm going to go ahead and start this minus 0, because we're going to convert those preferred shares. And again, the preferred shares were 100,000 shares, and each preferred share is convertible into 5 shares of common stock. So we're going to convert those. Therefore, no preferred dividends. Didn't exist, hypothetically. And then we've got $1 million in bonds, 1,000 bonds, each has $1,000 face value, 1 million bonds, and we're going to convert those. Each bond's convertible into 100 shares. And so we've got to add back the interest expense that we had on those. So 1 million times 5%. $1 million times 5% and times the taxes. 1 minus 40% or 60%. So let's go do all of that math. And so, 1 million times 5%, 50,000. So we had $50,000 in interest per year, but it only affected that 1 million by 30,000. We're going to add it back. So we got 1,030,000. Again, just repeat that again. Those $1 million of bonds at 5%, they had inside the net income $50,000 of interest. Well, at a 40% tax rate, you got to deduct 40% of that 50 million. That would be 20 million. So 50 minus 20, the net effect of that bond interest expense was 30 million. And I'm adding that back, and this is a plus, by the way, not a minus, thank you, because they're gone. We don't have convertible, hypothetically, they're gone. We don't have convertible bonds anymore. What do we have? We have shares of stock. So let's go add our shares of stock in. We started with 1,200,000 in basic, because none of that changes in dilutive. We still issued those shares. We still have the million, but now we're going to convert stock. So each share of preferred stock is convertible into 5 shares. So how many shares of convertible stock? We had 100,000. Each one of those, hypothetically, 100,000 of them converted it into their 5 shares. So guess what? Now we have 500,000 shares of convertible stock, a common stock, not convertible stock. You had 100,000 shares of preferred stock, each convertible into 5 shares. And we say they got converted. That's why there's no preferred dividends to subtract. How about the convertible bonds? Each bond is convertible into 100 shares. How many bonds do we have? We had 1,000 of those. So guess what? We're going to add back, we're going to convert those common bonds into $100,000 million worth of bonds, just got converted hypothetically into common stock. So what's our new math? 1,000,002 plus 500, 1,007, 1,800,000. Okay, 1,030,000 divided by 1,008,000, that equals 57 cents. Question 2 is that dilutive? Is 57 less than 75? Yes, it's dilutive. If it was greater than, we call it anti-dilutive. We'd find out which one of these was anti-dilutive, and we would ignore it. Okay, there you go. I think this is easy. I always think this is easy, but my students surprised me. And so I decided to create a second problem. Let's go do everything we just did again. And again, hey, pause the video. You go do this. And then if you're confused, all right, you better go back, get the textbook out, because I'm not reaching you. Get the textbook out, read the textbook, figure it out, then come back and try again. At least you have here, you get to see someone working. So number 2, basic EPS. Let me sharpen my pencil here. All right, let's see. We'll start with the net income. There's a lot of information here. At 100,000 shares. Reported net income for 2017 is 600,000. So we're going to start right here on our numerator, 600,000. And we're going to subtract any preferred dividends if we have any. Oh yeah, we've got 100,000 shares of preferred stock. And the par value is $5. And the rate is 10%. That's how we calculate preferred dividends. So you have to know chapter 18 to do chapter 19. Sorry, but this course does build on itself. And that's it there. And so we can calculate that out. Okay. You got 500, let's just do this. 10% of $5 par value is 50 cents. So therefore, we have 50 cents preferred dividend times 100,000 shares. You know, these actually happen. We're going to pay 50,000. So 600,000 minus 50,000 equals 550,000. All right, let's go look at, we had 100,000 shares. These were outstanding on January 1. And then we sold 200,000 additional shares. Don't really care about that $25. They like to give you extra information you don't need. So we're going to add 200,000 shares, but we don't add them all because we're going to do a weighted average. And so how many months were these outstanding if they got issued on March 31st? April, May, June, July, August, September, October, November, 9 months. So times 9 divided by 12. So 3/4 of that, you know, 75%, that'd be 150,000. So that only counts for 150,000 on a weighted average basis, plus 100,000 that were out there for the whole year. So I'm at 250,000. Earnings per share is 550,000 by 250,000. Basic EPS is $2.20. Let's go do diluted EPS. Hey, it's the one time in accounting you get to be do hypothetical stuff. What if, you know? So that's pretty cool, I think. So diluted, we're going to start with the same 600,000. And then let's go check our preferred dividends. Oh, they're convertible. So, and we're going to convert them. So -0 for the preferred dividend. How about our bonds? We had 100 5% convertible bonds, 1,000, you know, and bonds, by the way, I use $1,000 face value when we created this because that's most bonds have $1,000 face value. They may issue $10 million of bonds, but each bond has $1,000 face value. So they did 100. So they got $100,000 in bonds. All each is convertible. So we're going to convert them. What happens when you convert them? I don't have that interest cost. I got to add that back. And so I've got $100,000 in bonds times they're a 5% interest rate. And what's my tax rate? I'm going to do 1 minus 40% or 60% to calculate this out. So interest would have been 5% of 100, been 5,000, but I only get to add back 60% of that, or 3,000. So my numerator is going to be 603,000. How about my denominator? Okay, I'm going to start with the same 250,000 shares. That does not change in diluted. They were actually issued shares, and none of that changes. And so let's go convert our shares. So each preferred share is convertible into 5 common shares. And we have 100,000 shares. So that'd be 100,000 shares of preferred stock, each one converted 5, that'd be 100,000 times 5 plus 500,000. And each bond is convertible into 25 shares. We only have 100 of those bonds, so that'd be 2,500 plus 2,500. And so my denominator, 250, is 750, 752,500. So my diluted EPS is 603,000 divided by 752,500 equals to 80 cents. 80 cents is less than 220, it's diluted. So easy. You can do this. You got it. So yeah, again, the only thing I didn't put in examples is if you had, let's say, a 20% stock dividend, you would have to come back and if it happened after this date when we issued the shares, you'd multiply everything times 1.2. If it happened here before this, you'd only multiply this times 1.2. That would be a 20% stock dividend I'm talking about there. That's the only thing I did not put in this example. So it kept it pretty easy, because that's, probably the problem that'll be on the exams for my students. So again, thank you for bearing with me here. And I hope this material makes sense to you. Thank you.